In today's video, I'm going to be sharing with you the best candlestick pattern trading course. After watching this video, you are going to understand everything about the candlestick pattern. You'll be able to identify them on a price chart and also know how to make use of them. Candlestick patterns are very important in technical analysis because price action traders use them for entry. It helps you to know when to enter a trade. So in this video, you are going to learn everything about the candlestick pattern and how it is being identified on a price chart. Once you master candlestick pattern, you can use it alongside with your trading strategy, and with that you can be able to make money consistently in the forex market. Honestly speaking, once you master candlestick pattern, you'll be able to spot sniper entry, and that will help you to be profitable consistently in the forex market. So in the financial market, a candlestick pattern is a movement in prices shown graphically on a candlestick chart that traders believe can help them identify repeating patterns of a particular market movement. The candlestick pattern helps traders to be able to identify repeating pattern on a price chart. The candlestick chart was developed by the Japanese about 400 years ago, and it is now known as the Japanese candlestick pattern. So it looks like a candle with red and green color. So it depends on the time frame you are using, right? So each expiration of one color signifies a close of a particular time frame. So price action traders use candlestick to be able to analyze the price chart so as to know when to enter a trade and when to get out of a trade. So with the help of a candlestick, you can be able to see what is happening on the market. You're able to identify what is going on in the market. So that is what the Japanese used to trade the forex market about 400 years ago, and this has become the foundation of every traders. Every traders is now using candlestick chart to analyze their price, to know when to enter and when not to enter. There are several candlestick patterns. There are so many candlestick patterns, but we are going to pick the most relevant ones, the ones that matters, the ones that traders are using currently to do what? To pinpoint when to enter a trade and when not to enter a trade. So I'm going to discuss this one after the other. So my advice for you guys to pay clear attention so that you understand everything that this video is talking about. Now, for you to be able to understand candlestick pattern, you need to understand the candlestick chart. This is a green candle and this is a red candle. So this green candle symbolizes a bullish momentum, telling you that buyers are in control of the market. Why this red candle signifies a bearish momentum, telling you that sellers are in this market. So when you see a candlestick that is a green candlestick that is very long, right, it tells you that the buyers are in charge, the market is bullish. And when you see a red candle that is very long, it tells you that the sellers are in charge and the market is bearish. So now this is where the market open. The market open here, and the sellers push it a little down, the buyers step in, then push it up all the way to this high, and the market now closes here. This tells you that the buyers are very strong in the market. Here the market open here at the top, right? The buyers push it up a little, then the sellers step in and then push it down all the way to this point and to the extent that the market now closed here. So this tells you that the sellers are in charge, the sellers are in control of the market. So here we have the highs, we have the close, we have the open, and we have the low. So this is what forms a candlestick: the high, the low, the open, and the close. The same thing here, we have the high, the open, the close, and the low. So here we have the lower shadow known as the wick, then we have the large body, and we have the upper shadow. So for you to know a candlestick, so for you to know whether if buyers or sellers are active, if you see a candlestick, a green candlestick with small upper shadow and small lower shadow, telling you that the buyers are active. So if the candlestick has a large body with small shadow up and small shadow down, this tells you that the buyers are active in the market. The same thing applicable to the sellers. If you see a long red candle with a very big body, small shadow at the up and small shadow below, telling you that the sellers are active in the market. So this is how you can be able to read the candlestick to know who is actually in control of the market, whether if it's the buyer or if it is the sellers. And like I said, once you see a big green candle with small shadow up and down with a large body, telling you buyers are in control. And when you see a big red candle with small shadow up and down with big body, telling you the sellers are in control of the market. So now if you look at this candle, you see that this is clearly a bullish candle. This is a green candle, right? And you can clearly see that the body is too large with small wick. So this wick is a price rejection. So the rejection is very small, telling you that there's a strong buyers in this market. Strong buyers are in control of this market. So when you see this type of market, you should know that the market is bullish. So you should be doing everything possible to buy, and you buy during a pullback because the market is clearly in an uptrend. So when you see this type of market in a daily time frame, if you go to the 15-minute time frame or the 1-hour time frame, you will see that the market is in a very big rally. The market is going up, right? So that is why you see this long green candle. So it tells you that there's a strong buying pressure in this market. When you look at this candle tells you a strong price rejection. Here there is a strong price rejection. The candle is green, but the sellers are in control. So this tells you that there is a strong price rejection here, right? The buyers are weak, they can't control the market, right? That is why you have this long wick, right? So if you watch, you see that the price opened here, the buyers push the price all the way to this point, only for the sellers to push it down to this point until the price closes here. So this tells you that the buyers are weak, they cannot push the price any further. So once you see this type of candle on a price chart, it tells you that the sellers are strong and the buyers are weak, right? So if you see this type of candle on a daily time frame, and then you go down to the 15-minute or the 1-hour time frame, you will see what we call a rally up and a rally down, right? So it means the price went up and then came down. So if the market closes like it means that the price will continue going down. So this is an indication of selling momentum, telling you that the sellers are active in the market. So once you see this type of candlestick on a price chart, it means the sellers are active, the buyers are weak, because there's a strong price rejection, there's a strong buying rejection, right? The buyers could not push the price any further, rather the sellers step in and push it down. So here we can say that the sellers are in control of the market. Now when you look at this candle, this is what we call the doji. The doji is an indecision. Indecision means that there is no particular direction. The market is just going up and down, right? So if you watch, see that the market opened here and the buyers push it up, the sellers push it down, and the market now close here. So this tells you that there's an indecision in the market. right? So this normally occur when the market is in a range. The market definitely has no direction. The buyers and the sellers are in equilibrium. The sellers sell from here, the buyers buy from here, right? So this top becomes a resistance level, and this bottom becomes what? A support level. So when the price comes to this point, the sellers push it down, and when the price comes to this point, the buyers push it up. So in this market, there is what we call equilibrium between buyers and sellers. The buyers and sellers are exchanging price, so that is why the market ends up in a doji. So in other words, this is clearly a ranging market. So if you see this type of candlestick pattern on a daily time frame, go down to the 15-minute time frame or the 30-minute time frame, you will see that the market is clearly in a range. This is the highs and this is the lows. So the buyers and the sellers are just exchanging price. So that is why we have this small size, a small body candle, right? You can clearly see that the body is very small, right? The body is very small. Rather, there's so many rejection at the up and the down, telling you indecision. No one is stronger. The buyers and the sellers, no one is stronger. They are the same. They are pushing the price up and down. So it means the market is clearly in a range. So that is what this doji sign signifies. So now I'm going to go straight to the candlestick pattern so that I will explain them one after the other for you to understand how it works. So there are so many candlestick patterns, but I'm just going to list only 8: 4 bullish and 4 bearish. So these candlestick patterns are used to identify reversal, right? Telling you when a trend is over and a new trend is about to begin, right? So we have the bullish reversal, we have the bearish reversal. So they are just 4 in number, making it 8. But there are many, but these are the most relevant ones that many traders are using on the price chart. So now let's start with the bullish reversal, right? Let's start with the bullish reversal. So in the bullish reversal, we have what we call the bullish engulfing. The bullish engulfing. The bullish engulfing is when green candle engulfs above the red candle, right? So you can find this candlestick on a support level. Honestly speaking, candlestick pattern should only be identified at an area of value. What is an area of value? An area of value can be referred to as support and resistance level, a level where there is likely to be a reversal. A resistance level is where sellers are stepping in to push the price down, while a support level is where buyers are stepping in to push the price up. So you should identify this candlestick pattern at an area of value. Once you identify it any other place apart from an area of value, it will not give you the signal that you need. So this candlestick pattern must be identified at an area of value, support or resistance level. So take note. So there must be a trend for you to identify it. So now let's start with the bullish engulfing. So the bullish engulfing entails that there is what? A bullish reversal here. So the green engulfs above the red, telling you that the buyers have stepped into the market. So formerly the market was in a downtrend. The market was rallying down, series of red candle. The market was just going down, going down, going down. What you are seeing is red, 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 red. Then suddenly you now see a big, gigantic green candle, a big green candle that engulfs above the red candle at a support level. So when the price is going down in a downtrend, so when the price gets to a support level, right, the price now does what? The price now begin to range, and suddenly you see a long green candle that engulfs the red. So this tells you that the buyers have stepped into the market. So we call it the bullish engulfing pattern. So once you identify this candlestick pattern at a support level during a downtrend, it means the buyers have stepped in and there's going to push the price up, right? So what you will do is you wait for this green candlestick to close, you place a buy trade, and then your stop loss will be below the support level. So that is how you make use of the bullish engulfing pattern. The next one is what we call the morning star. The morning star here also tells us that the sellers are weak, they can no longer push the price down, right? That is why you see this doji. Formerly the price was going down, right, making series of low, series of low, series of low, and then when the price gets toward a support level, the price began to range, and that is where you see this doji. So the price began to range, signifying that the sellers can no longer push the price down. So as the price is ranging, that is when it formed this doji, this small cross sign. We call it doji. So what happened is, if the next candle that appear after this doji becomes a green candle that engulfs above this red candle, it now signifies what we call the morning star. So the morning star is a bullish engulfing pattern that tells you that the sellers are weak and the buyers are going to push the price up. So once you identify this 3 candlestick pattern on a support level after a downtrend, you should know that it is time to buy. So you only buy after the close of this green candle. So your entry will be at the close of this green candle, and your stop loss will be below the support level. So this 3 candle is what we call the morning star, and it must be identified at the support level. So that is it. The next one we have is what we call the bullish pin bar. The bullish pin bar signifies rejection, price rejection. So in this scenario, there is what we call a strong rejection, a strong selling rejection. You can see the long wick, a strong selling rejection. Formerly the price was in a downtrend, the sellers were pushing the price down, and when the price got toward a support level, the price got rejected and ended up in a long wick, forming the bullish pin bar. So once you see this, either this red or this green, any one of them, it tells you that the sellers can no longer push the price down, right? They are weak, and what you have to do is you have to wait for the close of this candle for you to place a buy trade. So this tells you that the buyers are active because the sellers were able to push the price down to the support level, then the buyers step in, then push the price back up till the price closes here. So this tells you that the buyers are active, they are very strong in the market. So you have to wait for this candle to close for you to take a buy trade. So it doesn't matter whether if it is red or green, right? It can be red color, it can be green color, they are the same. So if the candle ends in red, you can still take a buy trade, and if end in green, you can still take a buy trade. Both of them are bullish pin bar. So you must identify this at an area of value, that is at the support level after a downtrend. Then the next one here is what we call the bullish harami. The bullish harami is when there is a series of low, when the market is clearly in a downtrend, making series of low, and when the market now gets towards a support level, we now have what we call a gap up. A gap up is when after the close of the red candle, we now see a green candle that gap up out from the close of the red candle, because normally as this red candle closed, a new candle supposed to appear here. Normally as this red candle closes here, a new candle is supposed to appear here, right? But if there is a gap up, instead of a new candle to appear here, there is a gap up and then a green candle formed. This tells you that the buyers have entered the market, so they are going to push the price up. So once you identify this type of pattern at a support level, it means that the sellers can no longer push the price down and the buyers have entered. So you have to wait for this green candle to close for you to place a buy trade. So this is how you trade the bullish reversal candlestick pattern. Now we'll come down to the bearish reversal candlestick pattern, right? So this candlestick pattern can be identified at a resistance level, right? So this one is what we call the bearish engulfing pattern. The bearish engulfing pattern. The bearish engulfing pattern is when the red candle engulfs below the green candle, telling you that the sellers have stepped into the market. Formerly, the market was in an uptrend, making series of high, series of high, series of high, right? Forming green candle consecutively, green candle. And when the market got to a resistance level, there was what we call a strong red candle. A red candle appears that closes below the green candle. It now engulfs below the green candle. So once you see this red candle engulfs below the green candle, it tells you that the sellers have stepped into the market. So once you identify this at a resistance level, you have to take a sell trade, but you have to wait for this red candle to close for you to place a sell trade. So once this red candle closes, you place a sell trade here, and your stop loss must be above the resistance level. So this bearish engulfing pattern must be identified at the resistance level after an uptrend. So the next one we have here is what we call the evening star. So here there was a strong rejection telling you that the buyers cannot push the price up. So formerly the price was in an uptrend, making series of high with green candle. Then when the price got to a resistance level, the price began to range. So this is where we got this doji. The price began to range. Then after ranging for some time, we now have this red candle. The sellers now step in and push the price down to the extent that the red candle engulfs below the green candle. So the red candle closes below the green candle. So this tells you that the sellers have stepped into the market. So once the red candle closes below the green candle and closes, it automatically forms the evening star. So once you see this at a resistance level, you know that it is time to sell. So where do you sell? You wait for this red candlestick to close, you place your sell trade at the close of this red candle, and then your stop loss must be above the resistance level. So this is how you trade the evening star. You must identify it at a resistance level before it can work, not any other place but resistance level. So that is the evening star. So when we talk of the bearish pin bar, the bearish pin bar is just the opposite of the bullish pin bar. So here we can see there is a strong buying rejection here, a strong buying rejection. You can see the long wick, a strong buying rejection here. Formerly the price was in an uptrend, making series of high, with so many green candle, and when the price got to a resistance level, the price got rejected, only to end up in a long wick. You can see the long wick. So the price got to the resistance level only to end up with a long wick. So this is what we call a price rejection. So once you see this candlestick pattern at the resistance level after an uptrend, you should know that the buyers are weak. They can no longer push the price. So you should be prepared to take a sell trade. So where do you take a sell trade? You take a sell trade after the close of this candlestick. So once this candlestick closes, you place a sell trade, and then your stop loss must be above the resistance level. So this is what we call the bearish pin bar. A bearish pin bar is a candlestick pattern that tells you that the buyers are weak and the sellers are going to step in. That is why this rejection is here. That is why you see this rejection, telling you there is a strong buying rejection here. The buyers can no longer push the price up. Instead, the sellers step in and push it down. So once you see this candlestick pattern at a resistance level, you should take a sell trade. So the last one we have here is what we call the bearish harami. The bearish harami is also the opposite of the bullish harami. So in the bearish harami here, the price was formerly in an uptrend, and when the price got to a resistance level, instead of a new price to open at the close of this green, there was a gap down. So there was a gap down and a new price open, which is the red. So once price gets to a resistance level, and instead of a new candle to form at the close of this candle, a new candle formed after a gap down, it means that the sellers are very strong in the market, right? So it means that the sellers were already waiting. There was a strong order here. There was a strong selling order here. That was why immediately the price got there was a gap down. Sellers pushed the price down immediately. So that's why I have this gap down. So what you do is you wait for the close of this candle, you place a sell trade here, and your stop loss will be above the resistance level, and that is how you trade this type of candlestick pattern. So the bearish harami tells you that the buyers are weak, they can no longer push the price up, and the sellers are strong, they are stepping and they are going to push the price down. So this is how you trade the forex market using the candlestick pattern. And like I said, this candlestick pattern must be identified at an area of value, either support, resistance level. So you must identify them at an area of value before they can work. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this. Also, don't forget to turn on the notification icon to be the first to be notified whenever I publish new content. I will see you again in my next update. Enjoy the rest of your day. Bye.